and we have an economy that is still strong, and inflation, 3.5%, 4%, persistent. But our view is basically you're not being paid enough to enter into a 30-year contract with the U.S. government at a fixed price. 4.7 or wherever it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term. We went through this very unusual period with extremely low interest rates, where everything just got cheaper. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. The aspirational goal is to get to 2% inflation.
Inflation is going to stay here. The economy is in transition. It's going to hurt everyone longer than expected. Still, you can save yourself from deteriorating your money and actually can get rich. There are still potential solutions to weather the storm of inflation. You can actually invest in super companies and financial sectors that are giving investors optimism. The economy is slowing faster than recent data suggests. Ackman wrote in a post on X, formerly Twitter, adding that there is too much risk in the world to remain short bonds at current long-term rates.
And then the pandemic and, trillions of fiscal stimulus, the psychological stimulus of being free to roam after being locked up, all of these factors coming at once kind of lit inflation, and we still have this massive deficit spending. We still have infrastructure spending. The government's selling literally hundreds of billions of dollars of securities, bills, and at some point they're going to have to sell more and more of the longer instruments. And if you look at the balance sheet of the Federal Reserve, it's an imprudent balance sheet.
With a net worth of $3.5 billion, Bill Ackman, an American businessman, is a hedge fund manager and a well-known philanthropist. The man in focus today is a foresighted tycoon, anticipating global economic upheavals, taking a bold jump into the volatile financial market, all in the name of shorting these long-term bonds. With his finger on the pulse of the ever-changing world, Ackman sets the setting for a gripping story of risk and reward, portraying a picture of an economy in transition. He is the creator and CEO of the New York City-based hedge fund management firm Pershing Square Capital Management. Ackman is well known for his aggressive investing methods and propensity to take substantial stakes in a limited number of businesses. His investments in Chipotle Mexican Grill, Starbucks, and the Howard Hughes Corporation are just a few of the well-known activist efforts he has been a part of. The global economy has been impacted by inflation in many unanticipated ways. Over the last 2 years, there have been substantial consequences from global inflation, most notably a decline in consumer buying power as a result of rising costs for basic goods like food, gasoline, and housing.
We actually made almost $3 billion on 2-year rates. We've made a relatively modest profit here, so if we nailed it, we would have made more. But
are you still?
I sort of was quiet about it for a while, and then sort of made my point a couple months ago, and rates have moved a lot since.
Is it still on, that bet?
It is.
And how long will it be?
Well, until we're right or wrong.
I mean, are you still figuring that rates at the long end, the 30-year, for example, or however on the long end, are still going to go higher?
Yes. Look, I think there's, even in the relative short term, there are a number of reasons why rates can move a lot. Among them, right, we have a government shutdown. We're going into what looks like a highly probable government shutdown. We're going to have a data shutdown, right? All these little government agencies that put out data that the Federal Reserve relies on to decide whether to, adjust interest rates, then they're going to lose access to that data. So we're going to have sort of like kind of dark period. We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own any U.S. securities anymore, selling. We have Saudi Arabia selling. If you think about the United States, right? If this were like a business, you wouldn't have so much short-term. You wouldn't have, a third or more of your debt repricing within the next year. So it's not been managed. I think actually Steve Mnuchin did a good job as Treasury Secretary. The one thing he missed is he should have issued a lot of 30-year, 50-year, 100-year paper at crazy low interest rates, and that's going to be a burden.
Furthermore, people are under more financial strain as a result of stagnating salaries, while companies and investors are facing difficulties due to the ensuing instability in the financial markets. There are signs that inflation's iron grip won't be loosened anytime soon, which is causing an unstable economy. A harsh image of the impending storm is painted by the recent shutdowns of the government and data, as well as the worrisome reliance on foreign bonds, which suggests that an inflation problem is about to develop. The Federal Reserve's aggressive deficit spending is a further factor in the conflict. It is constantly pushing up long-term interest rates and making investors and market observers nervous about their financial stability. Against this backdrop of uncertainty, investors are advised to avoid the risky 30-year Treasury and its erratic trajectory, which is a reflection of the erratic swings in the economy. Let smart asset allocation, which provides a secure shelter in the face of economic uncertainties, act as a fortress to protect you from the market's turbulence. The path of inflation may be far from clear, but the Federal Reserve's relentless pursuit of higher interest rates is a clear indication of its resolve to combat the threat of rising prices, even as the financial industry prepares for what is to come. Bill Ackman explores the urgent problem of inflation in the US and clarifies its complex mechanics. Ackman describes how supply networks broke down and demand for goods and services suddenly spiked as a result of the pandemic, upsetting the supposedly calm seas of inflation. This spike, as seen by the dramatic demand and supply graph, boosted used automobile prices to record highs, suggesting a complete shift in the economic environment. Based on an abundance of knowledge, Ackman argues boldly that the current inflationary period is not a passing event, but rather the beginning of a new normal that will persist in the overall economic environment. He identifies the spiraling expenses associated with the renewable energy transition, the growing frequency of strikes, and the growing negotiating strength of workers as reasons that are perpetuating the inflation trend. The broad implications of this inflation rise are further highlighted by Ackman's insightful observation, which warns that the subsequent spike in interest rates might have a domino effect, making borrowing more difficult and intensifying the impacts of inflation across the economy. Amidst unstable economic times, a handful of enterprises possess a rare ability that enables them to navigate prosperously even in the face of rising inflation and unpredictable financial markets. They include the mighty giants of pricing power, Hilton, Google, and Universal Music, which rule supreme. These giants, unswayed by the fierce assault of inflation, skillfully negotiate the risky seas, steadfast in their determination to set prices and rule their domain. In his insightful discourse, Ackman explores the complex web of companies that survive the turbulent world of inflation, revealing the little details that set a stable company apart from its unstable competitors. He deftly dissects the benefits of the asset-light company model and provides a clear illustration of its ability to withstand turbulent economic times. He highlights the key benefits of an asset-light structure, which include reduced operational costs, no heavy physical assets, and a remarkable resistance to inflation's disruptive powers. The asset-light company model has advantages, and Ackman's research underscores how well it can handle inflationary difficulties. Ackman highlights the disparate effects of inflation on various business types by drawing a comparison between the aviation sector, which is more vulnerable due to its large asset base, and the restaurant industry, which has a more agile operational structure with fewer physical assets and lower operating expenses. Additionally, he emphasizes how asset-light companies may skillfully modify pricing methods in reaction to inflationary pressures, demonstrating their flexibility and resilience in the face of market swings. Certain firms show resiliency and become desirable investment opportunities during inflationary times. Companies in the energy and commodity sectors, especially those producing natural gas, oil, and precious metals, typically prosper because of the market's rising pricing and persistent demand. Because rental revenues and property prices typically increase during periods of inflation, real estate investment trusts also present themselves as sound investment options. Their income-generating real estate investments serve as a dependable hedge against inflation. Additionally, companies in the consumer staples industry, which includes necessities like food, drink, and home products, generally sustain steady demand during periods of inflation, which makes them a rather safe investment. Comparably, the healthcare industry, including drug companies, producers of medical equipment, and suppliers of healthcare services, usually see steady demand for its goods and services, indicating its resistance to inflationary pressures and downturns in the economy. Given their historical stability and resilience to economic risks, investors frequently regard these industries as possible safe havens amid inflation. Energy and commodities firms, which benefit from strong demand and price rises, continue to be a good bet for investors wanting to hedge against inflationary threats. Similarly, real estate investment trusts dependability in generating stable returns from real estate investments, combined with the enduring demand for essential consumer goods and the consistent need for healthcare products and services, solidifies their appeal as relatively safe investment options during inflationary times. Investors might possibly limit the negative impacts of inflation and position themselves for more consistent returns in in a turbulent economic climate by proactively diversifying their portfolios to include these robust industries. In times of economic turbulence, investing in resilient sectors can serve as a strategic hedge against the perils of inflation, Ackman suggests, highlighting the potential stability of energy and commodities, real estate investment trusts, consumer staples, and the healthcare sector. These industries, known for their consistent demand and performance, provide investors with a solid basis for navigating the uncertainties of inflationary pressures, instilling confidence and resilience in an otherwise turbulent market environment.